Dipan Mehta of Elixir Equities, pardon me. And Dipan, hi, good afternoon. Good to be speaking with you. Give us your sense on how you're looking at the market in terms of how under pressure or largely sideways that we've been today. This was the same case yesterday, barring the last 40 minutes where we saw quite the spike up. Give us your sense on which sectors do you think could do well? Because while PSU banks are leading from the front, IT today continues to be under massive pressure.
Good afternoon, and thank you for having me on your show. See, I think the broad market large cap indices appear to be flat, slightly declining trend, but there's a lot of action in small mid cap stocks, and the advanced decline ratios are generally very positive on most days. Investors' portfolios are doing well, traders are doing well, IPO market is doing well. So, as such, I think a large group of players within the market, they have no complaints. The problem really is at the institutional level, especially if you're a large cap investor, where I think that absence of growth, stagnation in a lot of large cap stocks is resulting in this kind of a market where the hardly getting any returns on large cap stocks, although the valuations are attractive. So that's part A. Part B, I think that there's a fair balance between the positives and the negatives. The positives that being that the earning season has been good, economy is in decent shape, and all the other parameters are fine on a fundamental basis, but we still have a ongoing geopolitical event. That threat remains, and that acts like a bit of a, I would say, barrier to going to the next level. And secondly, the liquidity. I think a lot of liquidity is being drawn out by the IPOs and the QIPs as well. So that's keeping mutual fund investment into secondary market on a slightly lower key. So basically, they're not chasing stocks. So having said that, I think that we can expect this kind of a sideways movement for a longer period of time. And eventually we hope for a breakout of the Sensex and Nifty on the upside. And the trigger has to be the resolution of the US-Iran war, and of course the concurrent fall in crude oil prices. Or then we should see massive FI investments taking place. Something has to trigger this kind of sideways movement to perhaps take it on the upside. But in the meantime, I think there's a lot of action in small mid-cap stocks, a lot of investors chasing many micro investment themes as well. And there's no dearth of interesting businesses which have got listed recently or now are nicely scaling up.
Dipan, I wonder how you're looking at Cyient, because that's one of the stocks in focus today. And what you make of the commentary, how realistic this 4x kind of revenue number, the 16% odd in terms of margins. I know the addressable market goes up, but how realistic is this?
Look at the track record. End of the day, management quality is summed up in the track record. And I don't think it's been that outstanding. Scient, as I would say, is amongst the average or slightly below average in terms of returns, in terms of performance. What they've done over here is they have talked up the stock by saying that, this is what they're trying to do, and therefore the addressable market has gone up, but there are risks in execution over here, and it is not that easy. So I would say, okay, we keep it on our radar, but I would like to see solid, growth in the quarterly numbers, and then only maybe take a view on this company, because end of the day, numbers is what drives the stock price higher. And while strategy is good, and targets are great, aspirations are fantastic. As investors, are you able to generate 17-18% top line growth and 20-25% bottom line growth? Because that's the basic bare minimum criteria for looking at investing in a company. And if you're able to meet that on a consistent basis, and there are certain very strong levers which suggest the longevity of these growth rates, then Cyient certainly will be a great story. And not only will the earnings drive the stock price higher, but the street will instantly start paying a higher P multiple, and that also could be a nice multiplier.
Kunal, I wonder what your view is with regard to the stock chart of Cyient and whether technicals indicate anything different.
Yeah, I think on the charts first, I sense that the worst now could be behind for Cyient, because after such a kind of a steep correction from a level of 2000 when the stock was in 2024 till 720, 740, which was I think a recent low for the stock a couple of months back. The carnage has been quite significant for the stock. And it now looks like, with this price action today, what you're seeing for Cyient, it now looks like that maybe the worst could be behind for the stock price. And, Cyient is such a chart that over the last, I think, 16 years, 18 years, approximately, you just look at the kind of movement the stock has gone through. There have been almost 3, 4 times in the span of the last 15 years where the stock has corrected by more than 40, 50%. So it's not that the stock is not accustomed towards sharp selling pressures, but it's just that historically we've seen that this is a stock which goes into a very sharp phase of rally, sharper phases of correction, and then another sharp phase of a comeback. I would sense that maybe a comeback of sorts could be in the making for Cyient on the long-term charts.
Okay, that's the take on Cyient on the charts. Deepan, some stocks from the broader end that are buzzing, they belong to the smaller private financiers, like an SPFC Finance is up 8%, Capri Global is up 7.5%, and you've got some more stocks from this pack that are doing well. How are you looking at this end of the financials basket?
I'm sorry, I didn't get your question. Are we talking about NBFCs or
We're
what
talking about
exactly?
smaller private NBFCs. How are you looking at them?
Smaller private NBFCs. Uh, see, there are NBFCs which are the way I categorize it, multi-product NBFCs, the likes of Bajaj Finance, Tata Capital, Cholamandalam, HDB Finance, Poonawalla Finance. Then there are the gold financiers like say Muthoot is there, Manappuram is there. Now IFL Finance gets a lot of its revenues from gold financing. Then there are the housing finance companies, and there are even within that also there are the housing finance companies which focus on the low ticket, the unorganized sector. So like that, there are many categories. There are the vehicle financiers like Shriram Transport is there, and there's Sundaram Finance. But on the whole, our preference is for multi-product NBFCs with usual disclosure that we have investment or have a client investment. And that's where I think that the business is far more, I would say, the diversification in the business, number of products they look at it, that provides a natural cushion in terms of the risk profile of the company. And all of these companies which are multi-product, especially like say Tata Capital, HDB, Bajaj Finance, Cholamandalam, I think they've displayed exceptionally good numbers last few quarters also. NPAs are also well within control, and management commentary is very positive. We do feel that the BFC space can grow much faster than the banking space per se. And I think investors who are looking to invest in the lending space should the best way to do would be through these NBFCs.
Deepan, within that basket, you spoke about multi-product NBFCs. How would you be looking at gold loan financiers? Because for the last couple of days, Muthoot, Manappuram have been doing well on gold prices edging higher. You've also had AB Capital that's announced its foray last week into the gold loan category. How are you looking at some of these names?
See, this gold loan business is now well discovered. And there was a time when Muthoot and Manappuram were available at very attractive valuations, but those stock prices also have gone up. And intense competition is coming within the segment from everybody, all and sundry, be it the banks, be it the multi-product NBFCs, be it new players like AB Capital. Recently, L&T Finance also did an acquisition. Tata Capital did an acquisition. So I think that is going to get a very, very crowded space, and that's going to eventually impact the yields that these companies are able to get. By yield, I mean the net interest margin. So I would be a bit cautious. As I said, if you want to have a large proportion of your equity within an NBFC, like, a part of a core holding, then you are best off in multi-product NBFCs. They can easily switch from microfinance to gold loans to vehicle finance to housing loans to consumer loans. So whichever segment is happening within the NBFC space, because they have a presence, because they have a customer base, and because they have distribution, they have collection, they have systems, they can quickly take advantage of the opportunities coming in that particular segment. Because I've seen this in the past. 2, 3 years ago, 4 years ago, microfinance was extremely hot, and then we saw what happened over there. Gold loan also, they come and go. Vehicle finance companies also, when the auto industry does well, they do very well, and then when things turn bad, then the NPAs go up. So in my experience over the last 20, 30 years in investing in NBFCs, I realized that it's better to play safe and go with multi-product companies so that whatever something they will do well for them, and they will grow. And you may lose out on a odd, single type of a financier like a gold loan company or a microfinance company or a two-wheeler financing company. But end of the day, I think when you look at a longer term basis, 3 years, 5 years, 10 years, I think multi-product NBFCs will give superior returns on account of superior performance.
And how are you looking, Dipan, at the larger lending space uh, from some of the mid-sized kind of banks? A federal bank, you've seen decent run-up, right? In federal bank in particular, there's that linkage that they'll probably go out and acquire Jana, even though not sure, they've come out and clarified that they've made full disclosure as of now. But just having your sense of this entire re-rating that's played out in federal, and could there still be some juice left in this one, and just in terms of both performance as well as re-rating?
Yeah, sure. I think there are three banks which come to mind, which we think can grow faster. And I will name them in the order of their capacity to grow faster and therefore their attractiveness. One is the AU Small Finance Bank. I think they are doing great work, and their kind of qualitative and quantitative metrics is amongst the best within the peer group. Then there's IDFC First Bank also, assuming they don't have any setback on any front, then they also are poised to grow much faster than the industry. And Federal Bank as well. Federal Bank, of course, I think is amongst the cheapest of these three companies. So sure, I think, selectively within the banking space, there could be opportunities. These are not multi-bagger stocks, but certainly they can give returns which are higher than the Sensex, Nifty, maybe the peer group companies. So investors can certainly focus over there. But by and large, I think our view on the large banks, be it SBI, HDFC, ICICI Bank, IndusInd Bank, Axis Bank, remains quite neutral to negative. If you see their pre-provisioning profits for the June quarter, they are either stagnant or at best high single digit. And that doesn't interest us because, as I said at the beginning of the show, that we need 15, 17, 18% type of a top line growth, 20, 25% of a bottom line growth. And I don't think that the large cap banks can sustainably deliver on that criteria. So for us, a lot of large cap banks are a complete avoid.
Okay. Dipan, last one with regard to Seagull. I don't know if you track this one at all, Seagull India.
No, not really. All I know is that it is an engineering construction company. Unless something special is there in it and some development has taken place, I don't know. But by and large, these companies move on the order book position. And that order book position is growing for the entire EPC space because of infrastructure investment by the government, by the state. So sure, I think they're good investments. They have a good run, good trading rallies are possible. But end of the day, it's a cyclical sector as well. And one should expect a high degree of volatility in their quarterly earnings. And I would say again over here, the larger companies offer good risk return profile. I mean, see what's happening in L&T. Every now and then they're getting massive orders. Their order book position is growing significantly higher than their revenue growth. And I think that the orders which they are getting just now, they are at a much higher margin than what the averages they are reporting just now. So as I said, I think in some businesses you want scale. When you're looking at investing in other businesses, you want a niche. And then there are other businesses where you look for something special, something different which the company is doing, some mode, some brand, some technology. I don't know where Seagull will exactly fall in it, but there are so many EPC players that we need to be a bit distinguish which is the winner over there, and that's quite difficult.
You like Dipan? Any names you can throw at us?
As I said, L&T is a great play. It's I think with usual disclosure, it should be part of every investor's core portfolio amongst the few large cap index company which can grow at that 14-15% type of a top line growth. Then another company which comes to mind is Adani Group company Semindia. It's run up significantly in the last year or so since the Adanis have taken it over. But then that opens up a massive opportunity for the company in terms of projects from the group itself. Again, disclosures, of course, at every stage, our views are biased. We are invested in it. These are not recommendations. These are just our, stock ideas. And then there is VA Tech, which is the third company which we have invested in. And VA Tech, what we like is a nice niche within the water space. There are quality players over there. And again, the kind of order book to sales ratio is fantastic. And they are in tough markets, be it the Middle East, be it Europe, and in India as well. And I think that, again, there's a company which can grow much faster than the average, EPC company. So when you look at EPC, you look for scale or you look for a specific position or opportunity, like as is the case of Semindia, or you look for niche players like VA Tech were back because water is extremely important globally, and they'll keep, governments will keep making investment in water projects, and that'll benefit a company like VA Tech were back. So it's better to be in such businesses than just pure road construction or pure, construction of office buildings or factories, which is like a very standard business, which is not that high margin business. So we prefer companies which have a niche and a strong position in a slightly difficult infrastructure segment, because that I think can generate higher returns than a kind of a Me Too EPC player.
Okay, understood. Dipan, thank you so much for your time today and thanks for sharing your views with us and our viewers.
Thank you.
Thank you.